Hey, you don't want to miss this episode. We're going to dig back into the Nelson Nash book for part 4, and we're going to talk about how you structure a life insurance policy when using the infinite banking concept. Hi, everyone. I'm Darren Mitchell, your host, and joining me today is Christina White. Christina, how are you?
I'm doing great, Darren. How are you doing today?
Fantastic.
That's awesome. I'm excited to jump into another Becoming Your Own Banker review of Nelson Nash's book. But before we get started, I do want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And also don't forget to follow us on our social media at Control and Compound on Instagram and TikTok.
All right. So how to structure a policy using the infinite banking concept. So let's start with mortality. That's where Nelson starts in the book.
1 second, just before we jump in, I want to tell everybody that it's pages 36 to 40 that we're referencing here. So I want to make sure that if you want to follow along in the book while we're kind of going through this, you've got the page numbers that we are referring to when we're going to, because he does have some pictures, the mortality table like you were going to talk about, in the book, if you want to refer to them.
Okay, that's 4 times she reminded me before we started to mention the page numbers, and I still forgot. So
It's good for reference.
I believe I need something on the wall behind you flashing to say, don't forget to mention those page numbers, you idiot. Thank you, Christina, for catching that. Okay, so he talks about to start building a policy. We use that engineer and actuary analogy. An actuary is like an engineer. So when an engineer is designing a product, the engineer sits down and designs all this product, does all their engineering work. In this case, it's the actuary. So a mortality table is just the likelihood of people dying. So the way they do mortality tables, they go out and they look at millions of people. So in Nelson's book, he talks about 10 million people they look at. And they say, okay, what's the life expectancy of these people? And then we can build our product. But it's not just a random pool of 10 million people, because a random pool of 10 million people would include people that are suicidal, people that have cancer, people that had a heart attack, people that weigh 500 pounds, people that, have all kinds of medical problems in history that, probably don't have a life expectancy as great as somebody who's in our 10 million population. And our 10 million population is someone that can qualify for a life insurance contract. So it's not the average age. Sometimes people look at average age and life expectancy and that. Well, the actuaries look at a different number, because if you're insurable, and if you can qualify, answer the medical questions on the phone, you're less likely to die than someone that is not insurable. So they look at that, and he uses a table from 1958, but he says, don't get hung up on it. It's basically the same. But I thought it was interesting. I think it's on page 36 in the book. He actually has the chart, and they basically, the mortality table said 25% of the people were going to die in their prime working years. In other words, prior to age 65. So that means 75% of the people are still going to be alive when they hit retirement. And that's the 1958 mortality. It would be higher today as mortality increases. So if you think of that, if you think of, the whole buy term, invest the difference stuff, well, what's the likelihood you're going to die by 65? Well, in the 1958 mortality table, it was only 25%, 75% chance you're not going to die. Most people's term insurance would be expired by then. So I thought that was interesting. 75% of people in 1958 were still living past age 65.
Yeah, and he talks about the issue being that people put so much focus on having life insurance between the ages of 21 and 65, and you're not really going to need it. It's not as needed then. So he kind of went back to talk about term insurance. So kind of what term insurance is and how long it's been around. And I guess, in the book, he says that term insurance was really the first insurance that there was. And we've talked about term insurance lots before, but it's, you purchase the life insurance for the length of term. It's in place for that term. After the term, you no longer have it. It isn't expensive, which is why people go with the buy term, invest the difference thing. But the problem is that it's unlikely that you're going to use it. And people started realizing that and saying, hey, this isn't actually a solution because we're outliving these terms. We need a better solution for this. And that's when they started looking at those permanent policies. And he refers to one of the first permanent policies being a single premium. people ask us about this all the time. If you can do a one lump sum, no, you cannot. So that we can't do that. But he talks about the one lump sum and how it kind of just, when they came out with it, it became banking and insurance in two is what it combined to. And then he talks about misclassification, and he's talking about life insurance. So you see it out there all the time that life insurance is a terrible place to save, and people say it's the worst place to save, stay away from it. And he argues in this that that's a misclassification, which we believe to be true, obviously. But he again, as in Nelson fashion, he goes through some stories of real life stories of where this has happened historically, and one of them's on a potato. So he references.
So infinite banking is like a potato.
It's no, I think it's not like a potato. It's just that the potato kind of had the same rap. It had the same rap as the life insurance, because the first time that it was the Europeans discovered potatoes, they were classified as a type of plant that was poisonous, and they would not touch these potatoes, because they figured that they were going to kill them, wouldn't touch them. But then turn around in time with Europeans, and you talk about the potato famine, when they were so dependent on that potato and they needed the potatoes. Same thing, just like the same product, life insurance, just the misclassification. And he says back when he wrote this book, he said that misclassification was such a problem where people only see kind of what's in front of them. I really think with social media and what we have today, it is so easy to misclassify things, because there's just so much information pouring at you at all times that if you hear someone say life insurance is bad 50 times over on your phone in the period of a day, well, that's what you're going to see. And that's what he says, is the problem when looking at life insurance.
Yeah. And I mean, there's we've got a couple hundred years history of why it's actually a wonderful spot to park your money. So the proof is in the pudding. It's we've got that history. We've got the dividend scale increasing, but you're bang on. I mean, you talk to the average person, it's you can't do that. You get that in real estate too, right? I mean, what do you mean you bought another piece of real estate? Like, where you gonna live in all places? Like, you can't live in 4 places or whatever. You can't live in 10 places. Whatever you have, it's like, okay, well, those people just don't understand real estate. They didn't invest the time to understand how it works. Same with infinite banking, same with cash value life insurance, same with life insurance in general. People don't invest the time. They have that a bit of a rival syndrome. Oh no, I know what that is, no good. And as you and I know, we see every single day, once we educate people on this, they see it. But going back to Nelson's book, he talked about the one pay. Again, we don't do the one pay. We've never really done the one pay. Most of them are like pay for 20 or pay to 90 or pay to 100. But the big thing is the MEC line, or in Canada, the MTAR line. So if you think of how to design a policy, we want to minimize the death benefit as small as possible. We want the smallest death benefit going in. Smallest death benefit is going to mean smallest insurance costs, therefore the highest cash value. So what we're always trying to play with that MTAR line is, what's Nelson say? You got to cuddle up to it?
Snuggle.
You got to snuggle up to the MTAR line. Now, again, I like the term maximum efficiency line. Where can I drive the most cash in there? Because I want to drive a whack of cash in there for the smallest death benefit. So that's what we're trying to do when we structure a policy, to say, bring the death benefit down. If there's death benefit you need, we can get that elsewhere. Bring the death benefit down, maximize right up to that MTAR line, the deposit you put in. So effectively what you have is you have the most money that you can put in at that particular age, the most money you can put in for that particular death benefit at your age. And that's what we're trying to design a policy to be.
Exactly. And that's if you're setting up the infinite banking concept or, working with it, that's the type of policy that you need. The second piece in that is choosing your dividend option. So, and he refers to this, you have to choose the paid up additions. And we talk about that all the time. There are other dividend options out there. If you want to use the infinite banking concept and you want this structured right, you have to pick paid up additions, because what that's going to do is it's going to purchase additional participating whole life, which is going to then increase your dividends, grow your policy, and it's going to keep everything inside. So we don't want a dividend check being issued and taking that in cash. We want that uninterrupted compounding for life, like we talk about all the time. And the only way you're going to get that is by using the paid up addition.
Right. So there's like 4 or 5 different options you can select for your dividend. Number 1 is there's paid up additions. Number 2, 3, 4, and 5. Doesn't matter. Never
We
select
don't
them.
do them.
Paid up additions. I've never been involved with an insurance contract where I didn't have paid up a whole life without paid up additions, where I selected an alternative dividend structure. Even Nelson talks in his book about he selected premium reduction on one of his old policies he bought in the 50s, and he kicks himself saying, imagine how much better that, it still looked incredible. It was growing by 10 times what he put in a year. But he goes, if I hadn't have done that premium offset for the first 10 or 15 years. So paid up additions every single time.
Yep. So that's one. And then the other piece when setting these up, when using, we're using the participating whole life, we're doing the paid up additions, and then we have to do that additional deposit option. So that's what we call it here. He calls it overfunding in the book, which is how we reference it too, right? So overfunding that policy, really maximizing the cash values. And how we do that here is with a additional deposit option, premium plus. They call it different things with different companies, but that's really just jamming all the cash in there. As much cash in there as possible, right up to that MTAR line is what we're doing, right? So exact opposite of what you think for when you're using life insurance. A lot of people are like, I want the cheapest life insurance out there, and on this side, you're like, I want to put the most cash I possibly can into that policy to really maximize the efficiency.
Yeah. And that's it. We're minimizing the death benefit, maximizing what we can put in, plus the deposit option overfunding, maximizing it, just snuggle up to that MTAR line. So if we go back to kind of some misclassifications, Nelson talks about his kind of views on some of these other products, and he talks about Universal Life. And Universal Life was created in the 1980s. I remember when Universal Life came. Sorry, I shouldn't say I remember when it came out. I was still in school, but I mean I remember working in the 90s when UL was the new, latest, greatest, coolest thing, right? And really, it was invented by someone in this that was a stock market guy. And the idea was, we're instead of putting the money in a whole life fund where we have this participating account that has a 150-year track record of paying a dividend each year, it's like the stock market's doing 12, 14% a year. It's the 1980s, man. Things are rocking. It's always going to be like this. We should put the stock market inside an insurance product, and then we're gonna be set. Well, stock market didn't always do that. Massive fees in there, massive volatility. Can't get loans on that up to 90% because it's so volatile. But again, back when it was designed, it was stock market was booming, or even the 1 year term or the yearly renewable term. It was the same idea. If interest rates were 10 and 12 and 14%, and you could buy a GIC in the policy at 12 and 14%, well, that sounded like a great idea. But then we all know what happened to yearly renewable term life insurance. The rates skyrocket as you get older. The returns are never what you expect. And there's a day of reckoning coming where you're 60-some years old and you call your advisor's office and say, I thought this was paid up. Why do I have a bill for $25,000 a year now? Because it's not paid up, because those yearly renewable terms. So again, a lot of these products weren't designed by insurance experts. They weren't designed by the people that have been in the business for years. It was stock market guys and the conditions in the 1980s. So if you look at now, Universal Life is never used for infinite banking, but it's great for a death benefit, but it's not a place to accumulate cash in my view.
Yeah, we've got a whole podcast on it that listeners can check out if you want to hear more about Universal Life and the differences for infinite banking. We've got that there.
Yeah, they even have in the States, if you watch American podcasts or YouTube videos, IUL. We don't have IUL in Canada. They have it in the States. I don't like it in the States. If it ever comes to Canada, I won't like it here either. There's no better product than participating whole life insurance if you're going to use the infinite banking product. Nelson even identified it back when he wrote this book. UL is not the way to go. You don't have the guarantees. You don't have the benefits. You don't have that. So anything else, Christina? So what pages were those again? Because I missed it at the beginning. I don't want to miss it at the end. Page
36 to 40.
I was just about to say page 36 to 40 in the Nelson Nash book, Becoming Your Own Banker, is what we covered today. Anything before we wrap up?
Nope. Just make sure you listen along for our next one, because there's lots more pages of the book that we're going to cover.
Awesome. Thanks for watching. Thanks for listening. Have a great day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.